All right, good morning once again and welcome to the webinar. Today we are going to speak about budgeting best practices for charter schools. So let's jump into it. So I myself am Matt Persin. I'm the Manager of Financial Analysis and Risk at Charter School Capital.
My name is Spencer Stiles. I'm the President and CEO of Charter Impact. Charter Impact is a business management firm specializing in nonprofits and charter schools. We primarily are focused on California, but do also work with a couple clients sprinkled nationally as well.
So the agenda today, we broke everything up into 6 main categories. We're going to start off with some of the top reasons why charter schools close. Then we're going to move into the life cycle stages of charters. Then we're going to discuss some revenue factors to consider when you're budgeting, as well as some expenditure trends. And then finally, we're going to dive into cash flow planning and some budget safeguard strategies as takeaways. And now we're going to jump into why charters close. So the reason we want to start with this up front is because we really want to highlight the importance of this webinar and the importance of budgeting, forecasting, and planning as a whole. So here's a graphical representation of the top reasons why charters have closed. So as you can see, the big orange slice is due to financial reasons. So that's the almost 50% of the reason why charter schools close is because of financial issues. So it's definitely very important to focus on financial forecasting and planning. And then the second biggest slice of the pie we have is mismanagement, which has multiple things buried in it, but sometimes that's also mismanagement of financials. So that's what we want the takeaway to be on that slide. And next, we're going to dive into the life cycle stages of charters. So here we have another graph, and on the y-axis is the number of students that a school has, and on the x-axis, it's the time in years of operation. So we've broken this up into 3 categories. The first one is the startup phase of a school. So we've defined that as year 0, so doors open, up until year 2 to 3. So the startup phase is mostly about surviving and establishing the charter school's brand, establishing yourself in the market, and starting to build up a baseline student count. So if you see there's a second bar at the bottom of the graph, the student percentage of your target goal when you begin the charter. So in the startup phase, student population is pretty small. It is 10 to 25% of your target. As we move on to the growth stage, that's where things get a little more interesting. You see the graph has a higher peak here, and that's because from years 3 to 5, there can be, depending on your model of your charter, a lot more expansive growth, depending on how you are set up. So we've defined this as the flexibility and the stability building stage, meaning as you gain more students, you're able to be more flexible in how you practice, and also you start to see signs of stability as your student population grows. The final stage we'll talk about here in the orange is what we've defined as sustainable maturity. So we'll get into this a little bit later in the webinar, but we've defined this as the efficiency stage, and that's where student growth starts to taper off, and you've really become a mature school that runs efficiently, and there's not a lot of things that can fluctuate your financial ability going forward. So now we're
starting with the different, sorry, go ahead, Matt.
Oh, go ahead, Spencer.
I was going to add as well, in terms of the various life cycle stages of a charter school, while the enrollment and challenges and other things that the school experiences vary significantly, both from a programmatic side, hiring of teachers, growing of staff, professional development, all of those kind of programmatic things that most charter school operators are used to seeing and expect on the instructional side. There are similar kind of stages and different challenges and changes in approaches on the financial side as well. And so starting with the startup phase, a couple bulleted points that we have here up on the screen in terms of best practices is to, number one, start with the petition budget. And while that may seem overtly obvious for a lot of folks, depending on the timeline of your charter approval process or how long you spent in development of the charter petition itself, there can be a significant amount of time that passes from the time that the petition budget was drafted and you're actually getting ready to start operations. And so during that timeline, there's often significant changes in both governmental funding as well as costs of goods, potential salary scale changes, changes in benefit costs, all sorts of things that can be moving around and changing while you're going through the petitioning process. The reason why it's important, though, to start with that petition budget is that's really the kind of foundation that everyone who is involved in your new charter school has a frame of reference and a reference back to. And so you would have spent significant amount of time talking through student-teacher ratios, the different levels of professional staff that you want to hire, expected costs of textbooks, technology, equipment, all those sort of things. And everybody who's been a stakeholder and been involved in that process kind of has that frame of reference on what is affordable and what is not. And so using that as your starting point and making adjustments going forward often makes it significantly easier to communicate to various stakeholders on what is changing from what was originally discussed, as opposed to throwing the petition budget out altogether and starting from scratch. Moving into the next two bullet points, numbers 2 and 3, it's definitely a good idea to pay very close attention to mapping out your school's priorities for the year. And so similar to when you look at, from an instructional perspective, how you want to focus instruction, professional development, the different kind of areas of your educational program that are really your priorities, from a financial perspective, we typically look at things in the exact same way, meaning that where you focus your resources and where you focus your spending is very indicative of what your school's mission is. And so it's very important to ensure that kind of how you're prioritizing spending and where you're focusing your dollars is also matching to your mission and as well as the focus of your instructional program. Number 3 there, having a plan to show how costs frame the proposed budget. This is specifically important when you're dealing with kind of a decentralized purchasing model. And what I mean by that is if you have various stakeholders, whether it's your teachers or maybe you have multiple organizations that you're opening with several different principals, it's always very important that they understand exactly where their area of focus or their area of purchasing fits into the budget. And so having that kind of framed out and giving them and those individuals that perspective makes it significantly easier to ensure that when you're doing kind of a roll-up or looking at things on more of a combined basis, you don't have small individual costs by department getting out of control. And then lastly, just in terms of the budget management process, I've always found that it's significantly easier to go through and include absolutely every expense and everything that you would ever want on your wish list when you go through the first draft of the budget. Now, the reason I say that is because when you go through that process from start to finish and include, once again, everything that you can think of, everything that you would want, it's entirely likely 99% of the time that when you're done going through that first draft, you're going to end up with a huge deficit. The fact of the matter is there's typically not enough funding, regardless of what state you're in, to afford absolutely everything you would ever want to do into an instructional program. However, by starting with this process and including everything, including the kitchen sink, and then going backwards and eliminating things that maybe aren't as high on the priority list from a startup perspective, it allows everyone who's involved in that budgeting process and all of your stakeholders the frame of reference on what is affordable and what is not. The reason, or the opposite of that, if you start with kind of the bare minimums and you have kind of a larger surplus going into the budget, but you didn't really have those detailed discussions on all the different options on technology or professional development, and you start the year out, it's entirely likely that both teachers, administrators, and anyone else that's kind of involved in the operation of the school are going to have a boatload of questions about, was this in the budget? Was that in the budget? Can we afford this? Can we not afford this? And having started with a budget that included all of those items and everybody's wish lists, there's an easy frame of reference because that discussion's already been had before the school year started on what can be included and what can't be included in order to maintain fiscal viability. So I've always found that it's best to start with everything you could ever wish for and then cut from there in order to get to a balanced budget. That being said, and moving on to number 5 here, plan for surprises. And so again, referencing back to starting with your wish list and scaling back and removing things that aren't as high on the priority list back to a balanced budget, it's important that you don't remove things to get to an exactly balanced budget. Because the one thing that's a guarantee during your startup year is there are going to be things that come up that you did not expect, that you didn't plan for, or because it's your first year of operations, maybe your estimates were wrong. And so depending on the timing of when you created the budget process, you may have felt like you had a pretty good estimate on per student textbook costs or different kind of supplies needs. The fact is your first year in operations as a brand new business is there are going to be surprises. There may be facility issues. There could be repairs and maintenance issues. There could be changes in enrollment versus what you expected. And so ensuring that you're either being very generous in terms of your budgeted expense line items, in other words, kind of fluffing them up a little bit for the unknowns, or you go the route of ensuring that when you finally approve a budget to get the year started, that you do have a significant surplus available for those unexpected items is fairly critical. Otherwise, what ends up happening is every single little bump in the road that comes up, especially during the start of your first year of operations, you're kind of going back to the drawing board and going back through that kind of difficult process of figuring out what you can cut, what doesn't absolutely need to be a priority in year one, and it becomes a very difficult and kind of very tedious process to manage as opposed to preparing for some of those unexpected items from the very beginning. The next one, in terms of laying the foundation for an annual budget, I've always found it to be a best practice to do a very thorough budgeting job and include all of the stakeholders that are going to be involved, including even providing a summary to your teaching staff on what is included in the budget, even if it's just from a high level. And so they understand exactly what the school can afford and can't afford, and at least have a framework of what the school needs to do to maintain fiscal viability. Having that process in place from the very first year of operations then sets the foundation and sets the groundwork for what people expect to see year over year, and definitely cultivates a corporate culture of inclusivity and understanding that kind of everybody's in the same boat, and it's not a separate fiscal team versus the instructional team where, you know, the accountants are always saying no because you can't afford it, and, you know, the teachers and administrators are usually more innovative and kind of looking for new things and looking for resources in order to improve the instructional plan. So starting from year one, having that kind of foundation of including all of the stakeholders, at least briefing them as to the financial condition of the organization, does lay a great groundwork going forward then year after year. And then lastly, plan for updates regularly, especially early on in your first year of operations. Going back to knowing that the first year of operations is definitely going to have a significant amount of surprises. It's very important for everyone to expect especially during the first month or first 2 months after the school actually opens, to have a fairly regular financial meeting or budget update, because it's important to have the flexibility and have the perspective that things are going to be kind of a moving target as you're getting new information. So whether that's, you know, maybe your enrollment's lower than expected or significantly higher than expected, costs are changing, whatever it is, there are going to be changes. And so it's very important that people go into the start of the school year understanding that although you've probably spent a significant amount of time having budget discussions and knowing what's affordable and what's not, everybody needs to be fully prepared that that's going to be changing fairly regularly, especially during the startup year and even into the kind of moving into that growth phase as well. So moving into the growth and mature phase, and looking at the budgeting process, starting with the baseline budget based on your previous year is usually an easier practice and makes an easier process for the budget meeting. The reason I say that is because, again, looking back at some of the prior bullet points, if you've laid the foundation of, including all staff, you've had a lot of regular budget or forecast updates during the start of the school year, you've probably knocked out quite a few kinks of the budgeting process and hammered out and solidified a lot of your assumptions during that first year of operations. And so usually in terms of the budgeting process or financial management process, your first year is when you're going to get the most lumps and bruises going through that and the most kind of unexpected items that come up. So while as fun as that is, it does give you great framework and great reference on how to move forward during that growth phase. And so starting with what went well during the during the first year of operations, what you thought you knew and what changed, as well as now what you know, what things are really costing, gives you a great starting point and a very efficient starting point to start on your budget in year 2, year 3, and year 4. So next, everything, and it's important to understand that almost all of your kind of funding and your budgeting is dependent on your enrollment projections. And so at this point, anyone who's been involved with the budgeting process or at least sat in on budget meetings or had those types of discussions, this is usually fairly an obvious point. But the group of folks that this is not always the most obvious to, or at least the extent that how important enrollment is to your financials, is usually your teaching staff or any of the other kind of ground level staff who aren't involved or sitting in on those budget meetings. And so even looping in basically all of your stakeholders on the impact of losing 1 student or 10 students or 50 students, it's usually a very eye-opening experience to show that maybe if you're missing 1 student per classroom and you have 20 classrooms, that can be hundreds of thousands of dollars in lost revenue. And so by giving that frame of reference, again, to really all of the stakeholders, especially the teaching staff, as well as any kind of support staff, definitely creates that kind of corporate culture of inclusivity and everyone's understanding of how critical it is to not only maintain enrollment, but also maintain attendance as well. And so if there are going to be fluctuations either up or down in enrollment, everyone having that frame of reference is going to be fully prepared for the kind of amount of changes that are necessary on either spending increases or budget cuts.
Thanks, Spencer. So the next 2 points we're going to talk about for growth in mature schools is the active management of cash flow, and then we're going to talk about accounts payable. So starting with cash flow, the reason this is important, especially in the growth and mature phases of a school, is you become much more flexible in your operation. Touching off the last point Spencer made, a lot of that is due to your enrollment. As you start to grow, or even as you get into the mature phase, your student population is a little more fixed and predictable, which makes your cash flow easier to manage and also allows you to be more proactive with your flexibility. So final point about cash flow is that everything we're talking about when we're speaking about cash flow is your revenue and expenses, but then all of the other items that affect the bottom line of cash, which can be financing, accounts payable, receivables, payables, all sorts of things that affect how much cash is actually in the system, which allows you to pay all of your critical things such as payroll and rent. So as we start to talk about point number 4, in understanding your accounts payable, this highly relates to point 3 of active management of cash flow, because payables are a huge factor when affecting how much cash is in the system. So thinking through being a growing or slightly more mature school, one thing to remember is that you have a lot more flexibility with your vendors, and you also really need to hone in on vendor relationship management. It's very important to reach out to vendors often and establish that relationship, because there is a lot of things that you can use to your benefit to make sure your school is sustainable and still keeping that dialogue between your outside partners. So it's always easiest to set expectations early with vendors. And another key point is to really know your challenging months or time frames throughout the year. It's very common that certain schools in various states have certain points in the year where revenue may be lower because you're catching up from a prior year, and there could be some tight cash flow management you have to do. So as long as you communicate that upfront to vendors and they understand that there may be a windfall of money coming in later in the year, if you establish that up front, there's a lot more ability to make that happen.
So the last one, partnering with your external service provider. This is a very critical item for really schools in all phases of their life cycle. And so if you're an organization that's working with an internal accounting department, it's fairly clear and fairly obvious that your CFO or your controller or whoever's really managing that process internally is in constant communication about changes that you're seeing on the instructional side, about different costs of textbooks, or based on a competitive environment, maybe there needs to be significant changes to the salary scale or benefits package. And so working with an internal accounting department, again, it's usually fairly obvious that they need to be involved, but it's also extremely important to have that same mentality when working with an external service provider or back office company. And so there are a lot of really, really good back office companies out there, but they're only able to provide you and schools with a really quality service if they're kept in the loop as to what's going on. And so speaking from personal experience, we always focus on our relationships with clients and focus on our perspective to be the exact same as that internal service or internal accounting department. And so by keeping your external back office company or service provider in the loop in terms of strategic discussions, changes that you're seeing in purchase prices, maybe changes in shifting priorities, is going to help them understand and work with your school significantly better and be able to provide you the financial guidance and expertise that they're really good at. If you do the kind of opposite and you're looking at them as more an outside vendor and just a processor of transactions, what inevitably happens is you start to lose out on the benefit of kind of the higher level financial advisory staff, whether they're kind of the vice presidents or directors or business managers, or regardless of the title. You're really not able to take full advantage of the expertise that's being offered by your business management firm or back office company. So it's incredibly important, again, to keep that communication open, just like you do with the vendors on what's going on, but even more importantly with your accounting and finance team. So moving into a couple different factors to consider, both on the revenue side, and then we're going to get into the expense side. After you've kind of gone through the process and you've really experienced the budgeting mechanics and how to work through that year over year, including stakeholders and setting budget amounts, there's a couple additional, sometimes not so obvious factors to keep in mind for schools that are typically later on in that growth phase or even into the maturity phase. And so starting with the first one here, it's very important to understand and keep track of the correlation between your free and reduced price lunch or low income student rate as compared to your fundraising. And so schools throughout the country have significantly different approaches to how they set their fiscal structure and how dependent they are on fundraising. So there's a significant number of schools that do little to no fundraising and focus strictly on governmental funds. And so this ratio becomes not quite as important. And then conversely, going to the other end of the spectrum, you may have organizations, and there are schools that have a significant amount of fundraising year over year and use those funds not just for special one-time projects, but to support ongoing operations and potentially a significantly more robust instructional program as well. And so keeping a very close eye on the correlation or the changes in your kind of student population is also incredibly important for schools that are looking to move or change locations. And so if you're particularly a school that is maybe on the tail end of your growth phase, looking at full enrollment and hoping to secure a permanent facility, it's very, very important that you're looking at and keeping track of the demographics of your that new potential site. And so the reason I say that is because if you're looking at a significant and maybe even not so significant change in those rates, your funding model becomes incredibly different. So for example, if you're operating a mixed SCS school, and for argument's sake, let's say it's 50% free and reduced price lunch students, and you're looking at moving to a location where the local neighborhood is more like a 25% free and reduced rate, you are likely going to see a fairly significant decrease in your governmental funding based on those lower, kind of air quotes, lower need students. And so at that point, it's important to look at your fundraising program and understand that if there is going to be a significant change in your revenue model, in other words, a higher dependency at that point on fundraising, it's important to have those discussions with who's ever in charge of your development process very, very early on, because especially for schools that are in that, again, growth to mature phase, you've already kind of developed certain levels of expectations with your community and with your stakeholders about how robust your instructional program is and the different types of programs that are offered. And so if you're moving into an environment where your per pupil revenue may be decreasing, you may not be able to really cut certain programs without having a really dramatic impact on your stakeholders and therefore enrollment and financial viability. And so taking that a step further into bullet number 2, the tracking of fundraising families, it's very important to get really into the granular detail of how successful your development and fundraising plan is. And the reason I say that, and speaking from experience as an accountant, it's very, very easy looking at budgets year over year and to say, well, historically we've been between $1,000 and $2,000 per student in fundraising, and so that's what we're going to continue budget going forward. However, if you're looking at potentially changing locations, number one, or just the simple graduating of students and students moving on to either college if you're a high school or moving on to other schools, it's entirely likely that there is not an even distribution of the amount of fundraising that you receive for every student in the same way that you have for the governmental funding. And so, for example, using the example of a 50% free and reduced price school, let's say you move to a kind of a higher need population area and that increases to 75%. So for argument's sake, let's just say that the 50% of students who don't qualify for free and reduced price lunch all provide some sort of donations or fundraising throughout the year. If you're going to cut that number in half because of your increased free and reduced rate population, the biggest question is going to be, which half are you removing? Are you removing families that, are donating $5,000 to $10,000 a year? And are those the families that are graduating or maybe wouldn't follow the school to a new family or to a new location? Or are you going to be losing families that have more of a track record of donating $100 or $200 throughout the year? And so when evaluating either moves to new facilities or even just your long-term planning, it's very, very critical to keep an eye on kind of where students are and where kind of families are in terms of their donations, especially if you're a school that operates with a financial model that's dependent on ongoing year-over-year fundraising to support the ongoing operations. The next kind of area to consider is restricted grants. And so this often kind of comes into play either very early on as your year zero startup phase, but more kind of interestingly, at least from my perspective, is in the later on in the growth phase or the maturity phase. And so the reason I say that is usually by that time in operations, your enrollment has kind of settled down, you have a good teaching staff in place, you're not looking at hiring entirely new grade levels worth of teachers and staffing, and so it usually frees up administration to spend more time looking for and going after higher dollar grant items, which often come with restrictions. The biggest risk that you have here in terms of both an operational, or basically comes from an operational mechanical side with the budget, as well as looking more kind of a long-term strategic program perspective. And so for more of the operational budgeting issue, what can often come up, or what's very easy to do, is to get very excited. Let's say you get awarded a $100,000 grant from a foundation. And as a part of that application, you submitted a budget which included spending on certain ground level or programmatic staff, maybe an allocation for executive director or whatever it is. Going through that in the budgeting process, it's very easy to get that grant letter and add the $100,000 into your revenue line items without being overly cautious that you're not also adding all of the restricted expenses as well. And so what can happen in those situations if you're not very cautious and very detailed oriented with what you're adding into the budget is you end up with as you're going through the year, your revenue items are kind of matching your projections as you're going along, which looks great, but all of a sudden your expenses start to exceed your forecast or your budget because you're starting to incur the kind of mandatory or required spending items related to that grant that you may or may not have included in the budget. The other risk, which is more kind of subjective, has to do with communication to stakeholders and setting expectations of your families. And so let's again say, for example, you received a 3-year grant to start an after-school program, and you're receiving $100,000 a year for the next 3 years. So even if you go through the budgeting process and that $100,000 fully pays for that after-school program and all of your costs, and you've gone through and you're operating this wonderful program, the biggest question is, what are you going to do in year 4? Because if that restricted grant runs out and you didn't go through a financial modeling process that would lead to being able to afford that additional program or that additional after-school program once that restricted funding runs out, you may be put into a position where your budget can't financially sustain a continued operation of that program without a restricted grant. And so you end up inadvertently offering this great new add-on to your program and great add-on to your school, and all of a sudden 3 years, 4 years later, you're stuck trying to kind of pull that back. And that can lead to a very, obviously, kind of negative impact to the kind of the school culture. And then lastly, the sustainability of institutional fundraising. And so this kind of goes along on the same lines, since most institutional fundraising is specifically for either startup, for expansion, for new products, new programs, new services, that sort of thing. And so similarly to the example I gave with the restricted grant, it's very important to know or have an understanding from the very start of any kind of institutional funding that you have a very specific plan. In fact, you probably have multiple plans, A, B, C, and D, on how you are going to sustain your program and the same level of spending when some of that institutional money runs out. And so again, prior to accepting any kind of restricted grant or larger institutional funding for various products, it's very important, both from an administrative perspective as well as from a board member perspective, to have an understanding on what the organization is going to do when those funds run out or potentially stop, and how are you going to maintain that program, or how are you going to communicate any kind of scale back of the program to your families and students. So moving on to the flip side of the equation, expenditure trends. So these items are kind of a couple things we've been seeing on a kind of more of a national scale, and trends on where dollars are being spent and where dollars are being allocated by charter schools. And so considering we've been in generally an environment of rising funding rates on a per pupil basis, what we've seen throughout the country is an increased demand for teachers, an increase in salary scales, and therefore lower unemployment rates. And so while that sounds great to have low unemployment, and especially for kind of the teacher and ground level staff, what that means from an economic perspective as the employer is you will be looking at higher demand for teachers, whether that's based on a specific subject area or specific credential, or because you have growing competition of other charter schools in your area, expansion of districts. What that typically leads to then is higher costs. And so while it's, again, we've been in kind of a general environment of rising funding rates per student, there's also a significant increase in your largest single line item, which is your personnel costs. And so going through the budgeting process on an annual basis is very important to also keep an eye on the long range and on kind of the future and affordability. And I'll also be bringing that up on a couple of the slides coming up here as well on the importance and the impact of that. So it's very important to keep an eye on those increased and plan for increases in your salary scale to maintain a really qualitative crew of teachers and instructional staff. The next one, retirement benefits. And so this becomes increasingly critical for schools who participate in a defined benefit plan. And so for those of you who are unaware, there's typically two kinds of retirement plans. It's defined benefit and defined contribution. And so a defined contribution is similar to, or would be a 401k or a 403b plan, where as the employer, you dictate how much and you define how much you are contributing on a year-over-year basis. And then it's up to essentially the participants' investment elections or overall stock market performance on what their benefit is going to look like 20 years from now when they retire. And so the benefit of participating in a defined contribution plan from the employer perspective is it gives you a high degree of control and predictability in what your kind of annual operating expenses are. Conversely, and what most charter schools and most public schools participate in, especially for the instructional staff, is a defined benefit plan. And so a defined benefit plan is normally what you would think of in terms of a pension, where based on a certain formula, your kind of years of experience and whatever your kind of highest level salary rates have been, it determines a fixed amount of money that your staff will receive from the day they retire until the day that they die. The hard part about that is there's an actuary in a room somewhere crunching numbers, trying to figure out how much money that a school needs to put away or invest today to ensure that a teacher that they're currently employing will have money 20 years from now, and also have to guess how long that teacher is going to live from the day they retire until the day that they die. And so what has been happening kind of across the country, and especially in California, is a lot of the defined benefit plans have been underfunded. And so in order to really fill that gap or to make catch-up payments to account for the larger number of teachers retiring, is they're slapping schools with a significant increase in the amount of funds that they have to pay. And so it kind of varies by state, but to give a frame of reference, in California, historically the contribution rates for the teachers retirement plan were about 8.25%. That's currently rising to about 16.2%, and it will continue to grow to over 19% of salaries. And so trying to maintain a balanced budget while continuously increasing salary scales and also trying to afford healthcare costs as well as kind of that growing pension cost can be very, very difficult. So it's very important to keep in mind, again, on the long-term range, that you've accounted for potentially significant increases in your retirement benefits. The next one is textbooks versus renewing or changing technology. And so going back several years, there was definitely a push, and there still is a push towards the use of technology. From my perspective and kind of with the schools I was working with, it almost seemed like the industry was going to very, very quickly eliminate textbooks altogether, either using software programs, online content, one-to-one student device ratios. However, that kind of pace of implementation has seemed to slow. And again, it seems that schools are kind of identifying and finding what their optimal blend is. That being said, it's very, very important to keep an eye on what it's going to take to replace textbooks or replace technology. I think everybody on the call is very well aware that students are usually not very gentle with devices, laptops, Chromebooks. And so while you may have a recommended useful life of 5 years, realistically, it's probably going to be closer to 3, potentially 2, depending on grade levels you're working with. And so looking at the kind of the budgeting process, even if you're coming into a year where you're not going to need a significant number of replacements of either textbooks or technology, it's very important that you don't accidentally, let's say, use a trend analysis to project your future payments using a non-replacement year as your baseline. Because what ends up happening is you'll undercut or you're under budget a lot of the costs of these major items without knowing it, and without knowing, go into a budget year or maybe set changes in salary scale that's going to lead you down a path of non-financial viability. And then next we have facility cost increases. So again, being based in Southern California, we are definitely no stranger to overly expensive facility costs. as well as what seems to be a rising interest rate environment. And so as an industry and as the number of charter schools continues to grow throughout the country, there will also become an issue of self-cannibalization as more and more neighborhoods get populated with additional number of schools that are very much in competition for facilities that are both affordable and zoned correctly. And so if you are an organization or working with an organization that are on the tail end of their growth phase and looking into a permanent facility, it's very, very important to keep in mind kind of the timing on when you move into those permanent homes, as well as how you are financing them. And so obviously with the lower interest rate environment we've had, going the tax-exempt bond route has been a kind of a blessing to a number of schools, and it allows a kind of fixed and permanent cost for a number of years. However, that is going to be changing. And so the facility discussion is usually significantly more difficult because of the variability and cost of either a third-party lease, the potential of trying to go to investors more on the tax-exempt bond route, or even if you have a related party or related foundation that's able to provide a facility temporarily, ensuring and planning for potential increases in costs down the road is definitely something to keep an eye on as well. And as an industry is more than likely to see a continued increase in those costs.
Thanks, Spencer. A lot of important takeaways that are sometimes overlooked. So we've spoken a lot about budgeting. We touched very briefly earlier about cash flow planning, and now we're going to go a little deeper into a few things relating to cash flow. So the first major section we're going to talk about is the timing of revenue. So the reason why cash flow planning is very important is because sometimes the budget I see as more of a static document that has a lot that goes into it, and the cash flow is more dynamic in nature, because when we're talking about cash flow planning, that can generally be upwards of 12 months forward looking, broken down by month, or sometimes a lot of schools find it more important to look at even a weekly cash flow forecast. So looking at the left side of the screen, the first thing I want to touch upon is what attendance filing or metric actually drives the revenue that your charter will receive. So the first point there is there a lag between the reporting of that attendance filing and the actual cash receipt for that attendance filing? And that's definitely something that needs to be modeled out, because oftentimes in many states what happens is there is an actual time frame where you submit your newest attendance or enrollment, let's say in December, but often the actual receipt for those students in the seat might not come for sometimes 3 or upwards of 6 months. So for a school that's growing, that puts a lot of strain and stress on the cash system, because you have onboarding costs for new curriculum and new teachers as you grow, but you're not going to actually receive the cash benefit until sometime later in the year. So that's important to map out and model. The middle of the screen, we're looking at revenue. Basically, the question to ask yourself is revenue a monthly line item, quarterly, or more variable? So oftentimes, most schools get a large chunk of their governmental funds, state funding, and it comes monthly, and it's somewhat more predictable. But oftentimes, grants, certain federal and local payments can be more more sporadic, and may come quarterly or may come every 6 months. And understanding how that's actually going to affect your cash flow is very critical, because having enough cash in the system is what's going to cover all your expenses. The final point I want to touch upon is it's always easiest to look at what happened in the prior year with regards to the timing of those payments. So as I just talked about, some things can be more variable, and if you have budgeted in the past for a large grant receipt to come in December, but it always seems to trail to later in the year, it's probably more beneficial to be a little more conservative and expect the cash receipt of that revenue to come later in the year, as it has in the past. So moving on and looking at the inverse side of everything, timing of expenses. So all of this is basically the same, but just flipped around. So it's definitely important to understand the costs that you have that are fixed monthly. Maybe you have salaries that are fairly static throughout the year, or rent payments, and then you have some others that might be more variable in nature. So the benefit to cash flow planning this out over the year, at least on a monthly basis, is that if you know there's some large chunk of expense that's going to hit in a certain month that's going to affect your cash flow, being able to reach out to your vendors and plan accordingly and deal with accounts payable management, and maybe if you need certain financing for certain times of the year, if you have that roadmap paved out and you understand it up front, it's much easier to be more dynamic in nature of how you operate your charter. So moving on to the third point, we're going to talk about some other non-income statement cash items that affect the bottom line of cash. So when we speak about cash flow, we're talking about all the revenue that's earned, all the expenses that are incurred, and then all of these items such as financing, receivables and payables, and capital expenses that actually affect how much cash is in the system at any given time. So if we break these out one by one and we start with financing, there's very different ways that charters can have financing, but the most important things to hone in on are the timing of your inflow of your cash receipts from whoever your financer is, and then also the opposite side, the cash outflow of timing, because there could be some form of structure where you have smaller payments at the beginning of the year, and then you have some larger lump sum or balloon payments later on in the year. And oftentimes it's easy to forget about that, but if you have that modeled out in an annual cash flow broken down monthly, you can start to plan ahead and figure out when you're going to have a large cash drain on the system. So moving on to receivables. Receivables are anything that you have earned in a prior time frame that you are expecting the actual cash receipt of. So one example we see often in various different states is a revenue that's earned in a prior period, but the actual cash receipt won't come in until a period at a later time. So sometimes that could be a revenue at the very end of your fiscal year that's earned, but the actual timing of the payment from the state or whoever the entity it is that releases the payment may trail several weeks. So being able to map that out and understanding how both affects your income statement and also your cash flow is important to note. The third bullet point for payables is where, when we spoke earlier about vendor management, that's where that becomes very important to realize, because there could be certain months during the year where cash flow is very marginal or tight. And then the fourth and final point I'd like to make on the slide of another item that can affect cash at the end of every given month are capital expenses. So a couple examples of this would be tenant improvements and facility upgrades. Those are also important to remember as you're potentially building out your space for a new year. Understanding how all of those are going to affect your year going forward is important.
So moving on now to the budget safeguards. We've spent a lot of time kind of talking about things that can go wrong and things to watch out for, and different things to worry about going through the budgeting process and looking at the various life stages of schools. So now we want to kind of move on to a couple different safeguard strategies, so you all have tools on kind of what do we do about it. And so we're going to focus these in a couple different larger buckets. So first and foremost, your largest expense item is going to be your salaries and benefits. So in terms of best practices, it's always very, very critical to review any salary scale changes that you make with the future in mind. And so what I mean by that is it's very easy to make a mistake going through your annual budgeting process, looking at the next 12 months saying, hey, funding's going up, There's increased competition. Our local district is rising their pay rates quite a bit. We need to be competitive. Look, we can afford a 10% increase this year. So let's go ahead and do that. The problem with keeping that kind of short-term view or looking at just what you can afford the next year is you may be inadvertently setting expectations of your staff, as well as putting the school on a kind of trend line towards financial disaster. So if you're looking at a fiscal year coming up with potentially a fairly significant increase in funding, those increases in funding are likely not going to stay the same every year. More likely than not, they're going to plateau, and the inevitable kind of economic downturn will happen at some point. And so without looking at kind of your affordability and that trend, and also understanding the expectation of staff, it could be very affordable and easily balance the budget in your first year, but in year 4 or year 5, you could be looking at significant deficits. And so also keeping in mind that maintaining a happy teaching staff and a very dedicated teaching staff is extremely important. It's very difficult from a human management perspective if you've developed a situation where year over year you've provided 5, 7, 8, 10% increases year over year to your teaching staff. They may get very, very used to those types of increases and not be quite so comfortable if you get to a year with less funding, and maybe you can only afford a 1, 2, or 3% COLA increase. And so it's always very critical, and it's definitely a good thing to keep in mind that even if you could afford a significantly larger increase, ensure that you're making the right decisions on a long-term basis on what is affordable and what is not. So the other thing, and the other way to look at salary scale increases as well, is utilization of both on-scale and off-scale increases. And so when I say on-scale increases, what I'm talking about is literally taking your school's approved salary scale, adding a 10% increase on every single cell and every single bucket, and setting that kind of groundwork then, or setting that as your baseline going forward. That's very different than saying, well, we can afford 5% this year, but we're worried about the long-term trend. And so let's put a 3% increase across the board on the actual salary scale, and then provide teachers kind of a one-time 2% off-scale incentive compensation, or not necessarily a bonus, but just increase in their salary number. So by doing so, you've provided teaching staff the 5% increase you want for next year without permanently increasing that salary scale by the full 5% that's going to roll forward year over year. And so by using that blend of kind of on-scale or off-scale salary increases, it allows you to kind of frame the increases very directly and very specifically for your staff, that maybe the 5% increase isn't going to continue year over year, and instead that it's kind of a one-time thing, but you're confident that a 3% salary scale increase would be able to continue in the future. And so it's definitely something to keep in mind. The other thing which I wouldn't be able to stress strongly enough is the benefit and the use of non-financial perks. And so regardless of any organization, either nonprofit, for-profit, charter school, or non, for any looking at kind of a corporate culture, of the top 10 reasons that an employee leaves an organization, compensation and their salary pay is usually not one of the highest. And so if there are ways where you can maintain a positive corporate culture and a positive environment and have your staff feeling satisfied in what they do and being involved, it's definitely a less expensive way than trying to kind of increase salary scales by a significant amount year over year. And so some different items that we have bulleted here are things like flexibility. And so allowing your teaching staff, once they've maybe reached a certain level or a certain level of expertise, to have a significantly larger amount of input into the instructional program will give them significantly more buy-in and satisfaction in what they do. The next one, recognition. Everybody loves to be told they're doing a great job. One of some very common complaints that come from employees from employers throughout the country, whether, again, for-profit or not-profit, is people feeling like they're really working hard but not necessarily getting that positive recognition. And so even if you're an organization that wants to have a teacher of the month or whatever it's going to be, it could be absolutely anything, having some of that recognition is a significantly less expensive way to ensure that your teaching staff and other instructional staff or classified staff are all happy in what they're doing. The other areas include things like corporate culture. So it's important to remember that tone is set at the top. And so maintaining a kind of positive, optimistic outlook will definitely trickle down through the rest of your staff and maintain that positive environment. Growth is incredibly important for definitely a number of employees and a number of staff. And so working with your teachers and understanding from every single staff member, what are their individual goals, what do they want to achieve with their own kind of career path, and ensuring that as their employer, you're doing what you can to put that in place. And so again, looking at things like professional development, whether it be in-house or external, is typically less expensive, again, than company-wide salary changes. And then lastly, ensuring that teachers understand and have the buy-in, or really all employees, that they're really making a difference, and ensure that they understand the impact that they are having on families and students. And so those are all kind of a few of really many ways that you could look at non-financial perks to provide to your staff, which will make the budgeting process much easier. The next area is setting reserve balances. And so I think probably on a weekly or at least bi-weekly basis, I get questions on what's the difference between a fund balance or your net assets and a cash balance, and which one do we care about? Depending on your perspective, they both have importance and they both need to be looked at independently. So your fund balance or your net assets is really nothing more than either the accumulation of all your surpluses and deficits going back to the beginning of time, or the other way to look at it is if you took all of your assets and everything that you owned, sold it all off, got it down to cash, and paid your liabilities, that's what you'd be left with. And so your fund balance is often looked at as a metric of financial viability and financial health. That's very, very different than the actual cash you have in the bank. And so I often try to give the advice or the perspective of, well, you might have a very large fund balance, but you can't use a fund balance to pay your payroll. And so from an operating standpoint, it's very important that while you may have this great financial metric, if you don't have money, or if you don't have cash in the bank, let's say tomorrow being the last day of the month to pay payroll, you're kind of in trouble. So keeping an idea or keeping a frame of reference on both of these is absolutely critical. The other thing to keep in mind when setting these targets is oftentimes state either mandated or recommended levels are nowhere close to sufficient for any kind of standalone operating business. And so let's say, for example, you're in a state where the recommended level is a 3% fund balance. Any business anywhere in any operations that stand alone would never be able to survive the slightest bump in the road with only kind of a 3% fund balance socked away. If you look at it from the perspective of an individual, let's say your annual salary is $50,000. That's the equivalent of saying, well, I've put away $1,500 in savings. I can now spend absolutely everything I need because if something goes wrong, I have $1,500. And so keeping that same example and then extrapolating that for your organization, it's very critical to look at a significantly higher fund balance to ensure that, again, when the eventual economic downturn comes, you're fully prepared for it. On the flip side of that is your target cash balance. And so, again, you may have a very large fund balance. Let's say your fund balance is $5 million, but you own a $4,999,000 building. What that means is you have a very, very small amount of cash, a very, very small amount of receivables, and you're probably not going to be able to operate or continue to purchase things as you need them because it's going to be a constant battle with cash flow. And so, again, looking at target cash balances, this really does need to be done on an individual basis because funding across the states is significantly different, and even funding across schools is significantly different depending on where you are in either the startup phase, the growth phase, or maturity. And so starting as a general baseline number, I've always found it to be a good recommendation of having at least 90 days of cash on hand at a minimum, or what that comes down to is about a 25% of your annual operating expenses, have that literally in cash ready to go to absorb the general ebbs and flows and needing of purchases, the timing of when teachers start versus the timing of when revenue is going to come in. That being said, I would again just really stress that those types of limits or even setting your fund balance really does need to be done on an individual school by school basis and does need to be a conversation with the board. The next major area is facilities. And so there's a couple large takeaways here. If you're in an organization where you're looking at a permanent facility and you've been blessed enough where you're purchasing or you're building your new facility from scratch and you're going to have this great new building to attract students to and have all this, be running this great program, it's very, very important, if you can, to plan for facility costs and facility space that's at least slightly larger than what you're actually anticipating needing. The reason I say that is, let's say your ideal model is a 25-to-1 student-teacher ratio. If you build a site with 20 classrooms and the actual classroom sizes are exactly big enough for 25 students and 1 teacher, you are adding a very significant amount of fixed cost to your kind of financial model and your budget over the long term, and you've now very much restricted and very much handicapped your variable revenue side of the equation. And so let's say, for example, you get into a situation where governmental funding starts to be reduced. Well, your rent isn't going to go down, your debt service isn't going to go down, and you don't have any space to add students. And so you're locked into a situation where the percent of your budget that's getting absorbed into your facility cost, because it's fixed, is going to start to grow. And it's very, very difficult and becomes very difficult very quickly to manage and maintain a balanced budget without making significant impact to your instructional program. So conversely, I always like to look at what is the max enrollment of a facility, not necessarily your ideal enrollment. So using that same example again, let's say you can afford, based on square footage, classrooms that are big enough for a 30-to-1 student-teacher ratio. Now, based on your program, you might be looking at, again, an ideal 25-to-1 ratio, and I think there's probably very, very few teachers out there that would say, no, pack them all in, give me all the students I can. I love having 50 students that I have to teach in a classroom. So that's not likely going to be an ideal situation. However, having that additional space for 5 students per classroom gives you a significant amount of flexibility if there is going to be changes in the funding environment. And so looking at, let's just take an average, let's say your state's providing $10,000 per student per year. And for whatever reason, the economy turns and funding starts to get reduced. If you take, of those 20 classrooms, and then you go from 25 students to 26, you just added $200,000 in revenue back to your program without adding a significant amount of expenses for things like textbooks, school supplies, and that sort of thing. So it's very important, if you're in a position where you're looking at a facility or new construction or tenant improvements or any kind of facility updates, ensure that you're planning not necessarily for just your ideal size, but if you can afford it based on the additional square footage, plan for a couple additional extra seats in terms of space. And then lastly, in terms of a facilities reserve, if you are in a permanent home, it's incredibly important and incredibly prudent to have a long-term repair and replacement fund that's starting to be built. If you've gone through the tax-exempt bond process, it's going to be typically required by your investors. Although even that being said, usually those fund balances that they require you to build are not sufficient if you're going to have any kind of significant roof repairs, HVAC issues, or anything else. And so especially for schools that are in that mature phase, it's important to start kind of saving specifically or setting aside funds for a facilities reserve. And also it's good to have not just funds for the repair and replacement of issues, but also look at your technology infrastructure. So usually if you're in the startup or growth phase, you're just trying to scramble and get equipment together to meet all of your students' needs. You haven't maybe necessarily looked at the long-term cost of replacing things like cabling, wireless access points, servers, switches, that sort of thing. And then lastly, going much further down the road, long after you've gone and you've left the school, the kind of your predecessors who are operating 20, 30 years from now may be in a position where they are eligible for some sort of expansion. And so having funds set aside and ready for that also wouldn't be the worst thing in the world. The next one is equipment or technology plan. And so again, looking at the inevitable cost of replacements, once schools have passed through that growth phase and they've gotten to their desired student to device ratios, it's incredibly important to have someone with a lot of technology expertise look at the changing technology, what's coming down the pipeline, what has been your historical useful life on devices, and what are you expecting to need or as things change in terms of your technology infrastructure. So taking the time to put together an actual equipment and technology plan will ensure that those on the finance side actually have some really good estimates on what those costs are going to be 3, 5, or 10 years down the road. And then lastly, it's incredibly important to set time at least on an annual basis just to have the board members as a whole, as well as management and anyone who's involved in kind of that CFO level budgeting process, have just a general discussion on the organization's long-term objectives and initiatives. And so, as we all very well know, boards are volunteer members. The school year ramps up very, very quickly. Everyone's busy. There's a lot going on. However, it's incredibly important to have that, even if it's a 20-minute or 30-minute discussion on a board level, on what is the kind of renew the organization's mission, what is the objectives, what are we trying to do, what is the executive director or what is the CEO focused on, because having that perspective will ensure that anyone involved in kind of that budgeting or financial management level, they will help then ensure that you are budgeting and setting the organization on the right financial track to meet those objectives in the long run. And so again, taking time to just have that just general discussion, force it on a board agenda once a year, definitely has a very strong impact and does help the school move towards financial viability in the long run.
Okay, so that is the conclusion of all the slides we wanted to go through. We're going to open it up for a Q&A. We got a question submitted to us on the phone, but I know we ran a little bit long, so for those of you who want to look at this webinar later on and reference it, we have the link right here on the final slide, as well as our YouTube channel, and then you have my contact information as well as Spencer's as well. So Spencer, I don't know if you can see this question, but I'll read it out loud for you and for everyone on the phone still joining us. The question that was submitted is, I'm noticing clients are choosing to finance technology instead of purchasing. Are you guys seeing this trend?
Yeah, it's kind of a mixed bag, and I think it depends on who the vendor is. And so depending on how that lease would be structured, sometimes essentially it's a 0% financing, and from that perspective, it can very much improve your cash flow because you're not looking at paying out those costs up front, especially if you're looking at a kind of $1 purchase option or something like that at the end of the lease. Having a lease can be significantly advantageous for schools. However, there are organizations that will provide and leasing companies that have an implicit interest rate included in those costs. And so it's incredibly important for whatever client you're working with that they provide kind of the details or what the options are from the leasing company of either an outright purchase or the actual lease terms. And then it takes a little math and maybe a little work on a spreadsheet to back into what that intrinsic interest rate is. And so from that standpoint, if you're looking at an interest rate that's maybe 1 or 2%, essentially you're looking at it as the same as borrowing money at a 1 or 2% interest rate in order to purchase those. If you're in a position where you have plenty of cash, it doesn't come up often, but it does. At that point, why bother incurring that interest cost? Or it could be a position where your general borrowing cost from, let's say, a line of credit or any other sources is more like 6, 7, 8%, at which point using that 2% kind of intrinsic value from the loan would be more advantageous. So it's a little bit of a case-by-case basis, and there has been, at least from what I've seen, it's kind of a blend of both. Sometimes you get that benefit of essentially a 0% loan, in which case I would say take it. If there's any kind of imputed interest, I would say, it's more of a detailed discussion.
Okay, great, thanks. We actually got one more that just got submitted. I'll read it out loud. It is, how do charters typically fund their startup budgets given the lag between opening the doors and getting their funding from the government?
Great question. So for argument's sake, let's say that it's not an affiliated school with a CMO, and let's say there isn't some sort of angel investor that's going to donate $500,000 to your school or any kind of foundational money. At that point, you have honestly very, very limited options. Unfortunately, because the charter industry is still looked at as being very new from a general corporate lending standpoint, it's very, very unlikely that you'd be able to find any kind of traditional line of credit unless you had a fairly wealthy set of board members who are willing to sign personal guarantees on that loan. And so other than that, other types of sources from revenue would be from folks like Charter School Capital, who do have the expertise and understanding of how charter schools are funded, what the trigger points are when enrollment is reported. And so with that basis of understanding on how the charter school financials function, they're in a much better position to provide funding for schools that a traditional bank who's maybe used to seeing small for-profit businesses doesn't really understand. But Matt, if you want to extrapolate on any of that, jump right in.
I think that's good. You basically touched on everything I was going to say aside from the charter school capital note, but I do agree with all of what you said. I think that is it for all the questions. So I think that will conclude the webinar. If anyone has any other questions or anything they want to talk to Spencer or myself about, once again, all of our information is there on the final slide. Thanks, everyone.
Thank you to everybody for participating.